Hey guys, Argent here. So there's a lot of young people who watch my videos, people between the age of maybe 17 and 22, younger than me, who may just have no idea about personal finance. Maybe their parents never told them. Maybe their parents were really bad with money themselves. Maybe they didn't have any adult figure to teach them that. You certainly don't get taught it in school most of the time. You pick it up from your parents if you're lucky. But I'm just here to kind of give you guys a bit of a guide and some tips when you're managing your money and just things to keep in mind as you go. And I'm in a pretty decent financial situation. I have all my student loan debt paid off, so that I have a good credit score. I have I have a decent amount of money in investments, and I invest about 10 to 20% of my net income into it. So I think I'm in a pretty decent spot, and I'd kind of like to share some things that I find have worked over the years with you. Now, I just like to say I'm not a financial advisor. I don't have a degree in business or finance or accounting or anything. My degree is in political science. I'm just kind of an average guy who I think's been fairly responsible with my money over the years. And I just kind of like to share some tips with you. I'm sorry if this video is going to be a little stream of consciousness, but there's a lot of stuff to cover. So you don't have to take my word for anything in this video. Hopefully this will just give you some ideas, maybe get you thinking. Please go do your own research. A lot of this stuff is very easy to find. There's lots of kind of introductory books. Something I will say, nothing in this will screw you financially. Nothing I'm going to say is radical. Nothing I'm going to say is some get-rich-quick scheme. Nothing in this is going to make you like, oh, I put all my money in this and I just lost it. Pretty much anything here you can reverse at any point. You can just stop doing, etc. But I think these are all things that you should start to keep in mind and work on. So the two main principles of investing, and we'll get into detail about these as we go on, are discipline and prudence. And we'll get into that in a bit. The first one is consistently saving, consistently investing. Maybe you don't buy that new TV and you pay off your credit card bills. Before you buy something big, you say, am I going to go into debt to do this? Can I afford it? Etc., etc. It's trying to keep your debt as low as possible, trying to save as much money as you can, and just trying to plan for the future. So you have discipline. The second part is prudence, which is, I guess in a sense, it's don't be greedy. If something looks too good to be true, if the rate of return is ridiculous, there's going to be a lot of risk. And you have to restrain yourself from being greedy. You also have to restrain yourself from saving too much money. I mean, you can never really save too much money, but sometimes it can really affect your quality of life. Like if you're my age, you're in your 20s, you're at the bottom end of what you're going to earn. In a decade, you're going to earn a lot more, and you're going to earn more and more every year till you retire. So you have a lot less disposable income at this point in your life. So maybe you want to save like 20% of your income. That would be the ideal. But you're living in a city, rent's expensive, and you can only manage 10%. And you could do 20%, but it would mean you could never go out drinking, you could never buy video games, you could never see movies at all. That is not a healthy state. You have to have balance. If you just kind of bottle it up, and if just extreme measures often don't work. It's like people go on starvation diets, they lose weight, they gain it back, it's not healthy. People try to quit things cold turkey. Sometimes it works, sometimes it doesn't. But for most people, I think it's better to try and be more financially healthy or physically healthy in a way that they can sustain. So let's just start going into personal finance. And let me just bring up a calculator and I can explain this. So this is a fairly basic investment calculator. You can find these, just Google investments over time, etc. And you can find one of these they're very easy to find. And basically this says, judging by a rate of return, fund fees, etc., if you save X amount of money, over X amount of time, how much will it be in the future? So it really adds up over time because you're getting interest and then you get compound interest, so you get interest on the interest. Let's say if you're 25 years old, and it really adds up, so we're just going to go look at this for a second. If you're 25 years old, you save $100 a month. That's $100 Canadian, so that's significantly less money in America. And you put $100 a month into your investments every month until you're 65 and retire. That'll be $100 grand. $100 a month Canadian is not a lot of money if you're making any kind of halfway decent salary. And 100 grand is not enough to retire on, but that would really help. Even if you were going to save for 10 years, you would have 15 grand. That's still a lot of money. That's a significant portion of a down payment on a house. In Canada, if you put down, I think it's 20% of a house's value, then you don't, on your mortgage, then you don't have to pay mortgage insurance, which is another couple $100 a year. So you can save money that way. Also, and this is something I think is very important, before you save, you normally should pay off your debts first. Because debts are black holes. Because whenever as long as you have a debt, you're going to be bleeding money. Let's say your debt is, I don't know, 10 grand at 1% interest. You have to pay back that 10 grand, but you're also paying an extra $100 a year in interest that doesn't help you. It gives you no benefit, the interest on your loan. And it's normally higher than that. Like if you have a student loan or a mortgage, it's probably, I don't know, 3 or 4%. And that can be like over $1,000 a year. So if you can save money beforehand, even if you say, well, I want a house someday, so I'm going to start saving, I don't know, maybe, let's go to a week, $5 a week from the time I'm 15 to the time I'm 30, then that would give you $5 grand, which would help with a down payment. But it can add up pretty quickly over time. And the more you can pay up front, the less interest you'll have to pay. So that's a way of saving money. So I think that's important. You always pay off your debts first, and then you worry about saving second. Because as soon as the debt's paid off, that's free up money. Like if you're paying, I don't know, like $300-400 a month towards your mortgage or towards your student loan, once that's paid off, you don't have to keep paying it. And then you can use that money for investments or something. So I think that's important. So when do you start saving? I think you start saving as soon as possible. Don't wait. As soon as you get your first job, I think it's important to begin saving immediately. In my case, my grandparents would always give me money, so I started saving before that. Now, there's a lot of things you can start saving for when you're young. Most notably for most people, it's education. I'm not sure how it works in other countries, but in Canada we have a RESP, a Registered Education Savings Plan. And for every dollar you put in, the government gives you 30 cents. So it's important to keep putting in money, put money in that as early as possible, because you get that bonus money and you get interest over time. And you get interest on the bonus money the government gives you. And let's say your grandparents are generous and they give you $300 a year or something from the time you're like 6 or 7. If you put 100 of that and you bank it to your RESP and you spend the rest, that's going to add up over time. And obviously that's probably not going to pay for your tuition, but it'll pay for a chunk of it, and that's money you're not going to have to pay interest on. And I think that's very important. And I think as soon as you start getting a job, you should get into the habit of saving. Let's say you do what I did and you start working when you're 14. You have a part-time job. Maybe you work 2 or 3 days a week. In Canada, the minimum wage is 11. We'll just round it down to 10 for convenience sake. So working 3 shifts a week is probably $140, $150 a month. And you should just start out and save as much as you can. So maybe, $130, $140 a week. So let's just round that to $150. Maybe you say, well, I need to, I'd like to spend some, because I'd occasionally like to buy a video game, maybe go to a movie, maybe hang out with friends, but I can maybe put, I don't know, 20% of that, maybe like $20 of that or $30 of that into my RESP every week. That's a good habit to get into. You want to immediately start saving whatever it is you can afford and whatever it is you can afford to miss. Even if it's $5 or whatever, that adds up over time. Even if you're not saving for your education, and it's good to save for multiple things at a time, save some money there. Maybe you're saving for a new computer. So that's just something to keep in mind. And by saving, I don't really even mean keeping your bank account. I mean investing it in something. Obviously, you don't want to spend your whole paycheck every week. So you keep a portion of it in your bank account and you invest as much of it as you can. Because in most cases, your bank account pays you less than 1%. And inflation's about 3%. So you lose money having money in your bank account. Even so, you don't want to put it all into investments because stuff happens. And sometimes it's hard to get your money out of your investments right away. But just you start saving as early as possible so your money grows as fast as it can. You start saving for the future. And it can add up very quick. Like you might not miss $5, $10 a week. But in a decade, that might be $3,000, $4,000, $5,000, and you can use that for tuition or part of a down payment on a house or a car or something. And it's good. It's also, I find it has gives you peace of mind to know that if you suddenly lose your job, you have a cushion to fall back on. You have some money saved. So start saving early, start saving often, and keep at it. Continually saving on a regular basis is one of the most important aspects of it. Generally speaking, where people lose money is A, they pick risky investments, but more than that, they panic sell or panic buy. That was kind of what caused the Great Depression to a large extent. The stocks all crashed on, what was it, Black Friday? The stocks all crashed and lost most of their value, and people would panic sell. They'd say, oh my God, my stocks dropped 60%, I better sell it before it drops 70%. The thing is, most of those stocks recovered most of their value quickly in like a couple weeks, but people had sold them all and they had lost their shirts basically because the amount of money they put in and even the amount of money that they had borrowed to put in, they had panic sold. And the opposite is you buy when prices are going up, and you so yeah, save early, save often, and pay off your debts. Pay off your debts as quickly as possible. So now people are going to say, okay, Argent, that's good, but where do I invest my money? If you listen to someone like Aaron Clary, who says there is no investments and just tells you to basically blow all your money and then when you get older, just shoot yourself. In the head, it's very easy to get very kind of negative and depressed about the whole thing. Oh, sorry, I forgot something because I'm a professional. Something I'd recommend you do very early on is get a credit card as soon as you can. Now, people are saying, well, Argent, you just said debt's a bad thing. And that's true. A, credit cards are just good because you can pay for a lot of things online that you can't with a debit card. But B, as soon as you start having credit, you start building a credit rating. So what I recommend you do is you use your credit card like a reloadable gift card and you pay it off every month. This is very easy to do. Pretty much every bank now, you can access your money online. You can pay your credit card off online. So you just, whenever you make a purchase with your credit card, just go in and put that amount of money against your credit card. And every month that'll go to the credit agency and they'll say, this man paid off his bills. This guy always pays his bills on time, and that'll start building your credit rating. And it'll go up and up and up over time. So why is a credit rating good? Well, it affects your ability to get loans. If you have really bad credit, that is, you never make payments, you've defaulted on loans, you've declared bankruptcy, etc., then people won't give you money or they'll give you less money. The other issue is interest rates. They'll give you much lower interest rates if you have a high credit rating, because part of what interest rates are is it's a way of guaranteeing they'll get their money back. Because if someone's a high risk of defaulting on the loan, they charge a very high interest rate. That was kind of what subprime was about, was they were charging extremely high interest rates because the people who were buying the mortgages had very bad credit scores. So they go, well, this person's probably not going to make all the payments, so we have to try and get as much money back as soon as possible. But if it's someone like me or someone who pays their credit card off every month and paid their student loans off, they're like, this guy is not a risk. We can give him a better rate because we're confident that we'll get our money back. And this takes a very long time to build, but it's extremely important, especially if you're trying to get a mortgage. I mean, it can mean a big difference. Like, let's say because you have a good credit score, they give you 3.5% instead of 5% on your mortgage. When that's like 100, 200 grand, that's a lot of money over time. So that's very important. Also, if you need money later, like you want to start your business, you need to get a small business loan, credit's very important. So that's something to do. It's something easy to do. It's, like I said, just pay your credit card off. You don't have to pay any interest. Get a no-fee credit card. Lots of banks offer credit cards that don't have an actual fee attached to them, and you can just use those. And it doesn't cost you any extra money, and you get a tangible benefit of building up a credit score over time. So, back to the original topic, what to invest in. Or rather, let's start with where do you invest your money? Now, this is going to be for Canadians. It's different in other countries, but I'll just talk about Canada. I think there's similar stuff. So in Canada, the federal government offers two different savings tools for people, the RSP and the TFSA. These were created to encourage people to save. I mean, we also have the Canadian pension plan, and in America you have Social Security, but that's not going to be enough money for your retirement. It's never was supposed to be enough money. The idea behind the CPP and Social Security is to provide a significant amount of money that, combined with seniors' own savings, it's to help out. So let's look at the two vehicles that we have here. You have the RSP and the TFSA. The RSP is a deferred tax account. So let's say, and this is not how taxes work, but let's say you make 50 grand a year and you're taxed 50% of that. Or we'll make it even easier. Let's say you make 100 grand a year and you're taxed 50% of that. If you put 30 grand of that in your RSP, you don't pay taxes on that 30 grand, you get the money back. So if you put 30 grand in, the government will refund you 15 grand because you don't pay taxes on money that goes into the RSP. However, when you withdraw it when you're over 65 or whatever, you will have to pay taxes on that. Now people say, well, that seems like a really bad deal, but you have to keep in mind, okay, what you're supposed to do is you put the money in, you get your tax refund, and you're supposed to put all or at least a significant portion of that back in the RSP. You get another tax rebate, and you wind up maybe you put, like in my example, you put 30,000 in, you get 15,000 back, and you put another 5,000 of it in, and there's that. Plus also it grows in money over the years. The tax rebate allows you to put more money in than you'd probably normally be able to, and that grows over time, and it's a very long-term investment. In Canada, you're allowed to withdraw, I think it's $20,000 to $40,000 from your RSP for a first mortgage. Now, you have to pay the money back, but you're basically taking a loan from yourself. So you don't have to pay interest on that. So sure, you have to pay the $20,000, $40,000 back to your RSP, but you're not paying interest on it. So it's still a good deal. So in Canada, I think it's 18% of the previous year's income every year, and that doesn't go away. So let's say, once again, you make 100 grand a year. We'll just round it up to 20%. You work 5 years, and your total amount will be $100,000 that you can put in. So that's a significant amount of money. And let's say you get a bonus one year, you can put more money in, you can top it up. That never goes away. You don't pay taxes until you take it out. The other issue, though, is it counts as earned income. So if you're taking out, I don't know, like $20,000-$30,000 a year when you're old, then means-tested Social Security will be clawed back. So that's how it works. And these two accounts can hold anything. They can hold stocks. They can be a bank account. They can be bonds. They can be what I'm my preference, ETFs. So we're going to get into that in a minute. But then you have the TFSA, which is what I would recommend. Generally speaking, if you make under 50 grand, you want to put money into the TFSA because you're not paying much in taxes. If you make over that, you want to put in the RSP because then you get more money back. Because you're taxed at different rates depending on the amount of income you make. So if you're making 20 grand a year, putting money in your RSP for tax refund doesn't really make sense. So the TFSA is what we have in Canada. So its limit is the number of years since you turned 18 times 5,000 plus there was an extra year it was 10,000. So at my age it's like 40 grand. So the limit to that is 40 grand. So this is a savings account. So you pay taxes on getting the money. So you pay income taxes on it. But any income you make in the account is tax-free. None of the money, like let's say you make 3-5% a year on it, you don't have to pay any income tax on that. You don't have to pay any capital gains tax on that. It's completely tax-free. And because you've already paid taxes on it, if you're older and you take money out of it, it doesn't count. Like let's say your entire savings are in your TFSA. You withdraw, I don't know, 30 grand from it a year. It to the federal government that counts as having no income because it's not income, it's previous savings. So you'll get Social Security benefits as if you were not making any money. So you can save it for any purpose. You can withdraw it at any point in time. It's your money, and that's good. I mean, capital gains taxes aren't huge, but it's more kind of the idea. You have this special account. You aren't paying any taxes on it, so it's a good tool to save long term, and it's a good tool for discipline. You say this is my tax-free savings account. This is different from my normal bank account. I'm not going to touch the money in here unless I really need it. I'm going to let it grow over time. And once again, the sooner you start putting money into these, the better. Now, I think it works different in the States. There's like the 401k and then there's the Roth IRA. I don't really know how it works in the States. So let's go into where you should be putting your money. And this is, once again, I am not a professional financial consultant. I've just read a lot of books, and this is what people tend to say. So if you don't know what a mutual fund is, what a mutual fund is a bunch of people buy shares in a mutual fund, and then there's investors who run the fund, and they use the big pool of money to try and pick stocks. They'll go, okay, I think this industry is going to go up. We're going to buy stuff in oil. We're going to buy stuff in coal. We're going to sell in this, and they try to play the market. They try to figure out what's going up, what's going down. And for all these investors and all these people who are running the fund, they command very large salaries. It's a very technical field. The problem is, over the years, it's become less and less competitive because there's algorithms and computers that do everything. So if a stock starts kind of going away from the trend, before, like in less than a second, computers will exploit it, and that'll stop. So it's very much kind of become a zero-sum game. What's interesting is the number of mutual funds that consistently beat just the stock market average is pretty much zero. Some might be higher some years, some might be lower other years. But generally speaking, there was a fund where a monkey threw darts at a list of stocks, and that actually did better than like 90% of stocks. It's of mutual funds. It's very difficult. The other issue with mutual funds is you pay a lot of money in management fees. It depends on the fund, but it can be 3 to 5%, and that's of all your money. So let's say you have $100,000 invested with a mutual fund, you'll be paying them $3,000 a year to manage your money in a way that's substantially less efficient than what the normal stock market does. You can also buy stocks yourself, and you can put those in a TFSA or RSP. My issue with that is, once again, you don't want to be playing the market. You can't beat the market most of the time. You don't want to gamble. Gambling is what gets people wiped out. Gambling is what kills money. So what you want to do, the other issue is, the closest thing to free lunch in investment is to diversify. So you buy a whole bunch of stuff in a whole bunch of different areas, and it's not all going to go down. Let's say you hold 100 different stocks. They're not all going to collapse. A couple might have a really good year. A couple might have a really bad year. But overall, you'll kind of get a consistent rate of return, which is why mutual funds were first founded. But they've kind of become useless over time. I mean, they're better, I think, in a lot of ways than owning individual stocks, unless you're really, really good at picking individual stocks. But it's had a lot of issues. The other thing you have to keep in mind is, a lot of times the people who run mutual funds are trying to be really risky, because the higher the rate of return, the bigger their bonuses are, and that's what in part causes risky shit that led to stuff like the financial collapse. The other thing I caution you on buying your own stocks is there's a trading fee. So every time you buy a stock, you have to pay a fee, and those can often be very high, and it can often be difficult to do. And also, do you really want to be managing your stocks? Do you want to go on every day, try to figure it out? Or do you just want something kind of nice and easy? And there is something nice and easy. It's called an ETF, or an exchange-traded fund. An ETF is basically the lazy man's investment, but it's also a very good investment. So what an ETF is, or an exchange-traded fund, is it's basically a mutual fund that makes no attempt to play the market. Basically, what an ETF will be is they'll pick something. Like, for those of you who don't know, like, the Dow Jones is a combination of the largest industrial companies in America, and it's an aggregation. So if it's like, I don't know what it is, like 30,000, that is the total price of every major industrial company in America's stock added together. The S&P 500 is the total price of every stock in the of every one of the 500 largest companies in America added together. So what these guys do is they go, look, we can't pick stocks. Picking stocks doesn't work. So we'll just buy the index. We'll just buy a share in our company will be, a share in our fund will be one of each stock in the S&P, or one of each stock in the Toronto Stock Exchange, or we'll make a fund that's like 250 of the biggest blue chip companies, or something like that, and we'll just spread out the money equally among those. And what's nice about that is you have diversification. You don't have people screwing around with the money. In most cases, I'm going to show you the one I use, but in most cases, they let a computer manage it. No one's picking investments. They set up the funds, but the funds are designed to be as simple as possible, as transparent as possible, and they don't play the market. What they will do is they will rebalance themselves. So maybe some stocks have a really good year and they go up. Like, let's say you have two stocks, and one, they both start at 50, and one goes up to 100 and the other goes down to 25. The fund will sell some of the one at 100 and buy some at the 25, because it wants to keep it stable. Because the benefit of an ETF is, it is literally every company on the Dow Jones going to collapse at the same time. No, that's basically impossible. And if they did all collapse at the same time, money's not going to mean anything anyways, because it'll mean it's melting down. A lot of those companies will produce stuff like toothpaste or bread, or just things that aren't going to stop being purchased at any point in time. So you're just saying, I'm not going to play the market. I'm just going to kind of invest in general. And there's all kinds of ETFs depending on what you want. There's ones that just hold government bonds. They just buy a wide range of government bonds from different governments in the world. And that's what the fund is. And you own part of all the different bonds. There's ones that buy corporate bonds. Corporations also issue bonds. Maybe they need capital and they don't want to sell stocks. So they'll issue a bond and they'll say, we'll pay you 3 to 5% interest for as long as you hold the bond. And they'll have bonds from hundreds or thousands of different companies. There's ones, dividend funds, where they'll hold just stocks from blue chip safe companies that pay dividends every year. And they'll give you the money from the dividends and they can reinvest the money from that. There's some that hold safe real estate. There's some that hold stocks overseas. And what's really good is you get a bunch of ETFs together and you have a very well diversified portfolio. Basically, because you have so much money spread out over so many areas, it's going to go up consistently because inflation goes up every year, I don't know, 3 to 5%. And the prices of a lot of things these companies offer go up 3 to 5%. If you own shares of McDonald's and their burgers go up, their profits are also going to go up. So it's a hedge against inflation. So it's just a very simple way. The other thing that is really nice about ETFs is the management fees, because it's literally a computer and maybe a couple of people who mainly deal with customer service handling an ETF. The management fees range from like 0.2% to 2% based on how much direct involvement there are, versus like 5% for mutual funds. And if you're paying a much lower management fee, that's money in your pocket and that's money that accumulates over time and is reinvested. So there's all kinds of different funds you can get. And I just think it's a very easy way to get in. It's a good lazy way to get in. It's a very emotionless way. So if you do this every week, then some funds will be up, some funds will be down, but it kind of will equalize over time. And we'll get into the one I use in a second. But yeah, that's an ETF. You don't have to take my word for it. Go ahead and look at it. I think it's an interesting path. So this is the company I use. So this is a sample of the kind of portfolio they would offer. So they kind of have a mix of different stuff. So equity is owning shares in companies. Equity is owning parts of companies. Stuff like that. The difference between the two is that equities almost always offer a much higher rate of return, but are a lot more volatile. The United States government isn't going to default on paying its bonds. Most governments aren't. Corporations might go bankrupt, but they also make a lot more money. So that's kind of the trade-off. The idea is, though, that they go, okay, well, we have some that are volatile, some that are more steady, so we're just going to mix a bunch of it together, and we're going to try and attain a stable growth rate that beats inflation. Once again, you can make a lot more money. There's other ways to make money. You can start off a restaurant franchise. You can buy rental property. Rental property is normally a good investment because you're getting regular income, and the property itself goes up. If you want to invest in an area like Detroit and the suburbs, you can get property for pretty cheap, and you can get reliable tenants, if you catch my meaning. So this is kind of what a typical portfolio looks like. So these are all different. ETFs that they have. So you have U.S. stocks. So this is just buying from an index of U.S. stocks. I think it's probably the Dow Jones or the TF or the S&P. Basically, they just take a basket of large stocks. They buy shares from all of them, and shares in their ETF is a piece of all these different companies. You have dividend stocks, which is large global companies that pay dividends every year. They're not very volatile. The companies share price doesn't go up as much, but they pay you regular dividends, which you can use to reinvest. You have foreign stocks, which are companies in Europe, Australia, and the Far East. So that would be like Japan. So that's in like steady, stable, developed economies in other parts of the world. So if America has trouble, the European stocks won't. Company bonds, always a good investment. Real estate. So normally there are real estate companies throughout North America. So these are ones that have like a lot of stuff. They might own hundreds of tenement buildings, own a bunch of rental houses. These are diversified real estate companies that have massive amounts of holdings. You have Canadian stocks. I live in Canada, so that would be like the TSX. You have emerging market stocks. Now these have a lot higher rates of return, but they're also a lot more dangerous. Just because, well, these countries' economies go up and down. You can make a lot of money, you can lose a lot of money, so they only allocate about 10%. Then you have government bonds, which are basically risk-free. So the idea is between all of this, you get a rate of return that, I don't know, like 4 or 5% a year. The fund management fee is maybe 1.5%, and you can sleep at night. And you can withdraw this money at any time. It's not going to crash. I think in my portfolio, real estate has fallen like 10% since I started buying in. And U.S. stocks have gone up, especially with the election of the Donald. But what they do 3-4 times a year is they'll go, oh, real estate has gone way down. It's dropped from being 10% of the portfolio's total value to 5%. But U.S. stocks have gone way up, so they'll sell your highest one and use it to buy more of the lowest one. So they'll keep rebalancing it. A computer deals with all of this. You don't have people screwing around with it. And Wealthsimple's a great company because one of the things they do is it's very easy to automate. You can just go in, you can set it up so, I don't know, you deposit 5, 10, 100, however much money anytime. And they have a cool app. Every morning I can fire up my app. I can see how my investments are doing. It'll say what's up, what's down, how much money you've made. It'll tell you when it buys shares and stuff. And there's no fee for buying things. So I can put in $5, I can put $5,000 in, and they don't charge a fee to buy anything. So I mean, there's a lot of companies like this, and you can just look it up. I think they're called robo-investors. And these are just good places to put your money. If you're a young professional, you don't know what you're doing, you maybe have a couple thousand, 10, 20,000, even $5,000, and you want to put it somewhere that's going to earn some sort of rate of return, you start putting money into something like this. Maybe when you're older and you have some more money, you want to buy a rental unit or something. But I know some people like to invest their money in their house. And that's okay. You can often make a lot of money doing that, but you have to be careful. Because property values can go up and down. You can make a lot more money, but there's a lot more risk. So I think if you're a young professional, you're a kid, you want to get into investing, sign up with something like Wealthsimple, find another robo-investor, something that offers a nice diverse portfolio of ETFs, and just put the money in that. Or even if you just want to invest money in a portfolio of blue chip stocks that pay dividends and just have the dividends go back and to buy more stocks, you can't go wrong with that. These are just nice, simple, they aren't exciting, they don't give you huge returns, but they give you consistent returns, and you aren't going to lose your shirt overnight. So there's one other thing I just like to talk about, and that is taking advantage of tax deductions. Now there's a lot of tax deductions that you might not even be aware of. Obviously the ones most people know about is the RSP, or retirement tax deduction, but you can also get a tax deduction for charitable contributions. So if you're like me, you give money to your church every month, you can deduct that against your taxes. You only get about a third of the money you've donated back, but why wouldn't you take that if you're going to donate the money anyways? If you live in America, you want to donate to Wikipedia, you can claim that on your taxes. There's lots of other things you can claim on your taxes. Medical expenses. You go to the dentist a bunch, you can claim that on your taxes. You won't get a ton of money back, but it adds up over time. In Canada, if you take public transit a lot, you can claim that on your taxes. I think it's only 15% of the amount you pay on it. But if you, I don't know, spend $4 or $5 a year on public transit, that's a decent chunk of change. That's like $600. That's nothing to sneeze at for something you'd be spending money on anyways. Education tax credits are pretty generous too. In Canada, you can deduct, I think, the entire sum of your education from your taxes. A lot of cases, you can carry these over to future years. Maybe you've maxed out the amount of deductions you can take for 1 year. You can put it on, you can roll it over to the next year. So always just maybe you can always Google common tax deductions, common deductions people don't take. I think it might even be worth hiring an accountant to do your taxes if it's not too expensive, because they will get you the best deal normally that you can, and you can get pretty decent money back on your taxes. And even if you want to do it yourself, do the research, look into common tax deductions, take advantage of it, and then basically, because it's free money, it's not money you'd be getting otherwise, put it in your investment account. Maybe put it in your RRSP, and then you get some more money back on your taxes. And you just want to be smart. So you want to pay off your loans, you want to save as much as you can, and you want to be smart about where you're saving your money. And you want to take advantage of anything that reduces your taxes. So this is kind of Argent's basic guide to personal finance. I know it was very long, but I hope this gives you some ideas. If you have questions, you can message me. I always have I try to respond. I've been kind of busy lately, but I hope you enjoyed the video and more stuff to come.